Hello everyone. So in the last video I made, it was a video regarding what is bookkeeping, what does the IRS require for bookkeeping, why is an easier method of bookkeeping better for small businesses. So kind of went over a little bit of what that was and how you explain it. And it was interesting because there was a woman who was very upset and said, the premise for SyncBooks is all wrong. Bookkeeping is accounting is essential for for businesses. And I agree. I never said that accounting wasn't essential or that bookkeeping wasn't essential. What I said is QuickBooks is not required, right? And I think that there's a lot of allegiance and a lot of loyalty to people that have branded themselves around being pro advisors and stuff like that with QuickBooks, which is great. And like I said, there's nothing wrong with that. It's just not necessary. Big difference, right? And so my next video that I'm making right now is basically continuing the positioning of SyncBooks with what is a P&L, what is income or gross receipts, and what are expenses. And for me, I'm just trying to keep it at its most fundamental level, right? Like, what does the government require? What are you at the bare minimum required to do? And so is it this sophisticated system? I don't think so, right? And so start off briefly with what is a profit and loss. I just found something online and says, what is a profit and loss statement? Profit and loss statement is a financial statement that summarizes the revenue, costs, and expenses incurred during a specific period, usually a fiscal period. So let's just presume we're going to use a 12-month calendar year, January 1st to December 31st, right? Something just very simple and basic. So at the bare minimum, you are keeping track of the gross receipts or the revenue that's coming in and the expenses that are going out, right? The expenses, the money that you spend. So, I just looked this up just to have like a brief explanation because people use different words synonymously. I think that's the right way to say it. So I just want to make sure that I explain a little bit of what it is. So gross receipts refers to the total amount of revenue you take in, while income refers to how much you keep based on your expenses, deductions, and other accounting factors. And I've seen it used both ways. For example, people will just count income as any money incoming, right? Any money coming in. And then I'll also see people just refer to gross receipts as any money coming in as well, right? And they call it an income and expense, but I guess it should be called the gross receipts and expense, right? Because at the end of the day, it's your profit and loss. So let me sort of take that back. So it's called your profit and loss, your P&L. Do you have a profit or do you have a loss, right? That's sort of where the P&L comes from. So in your income statement, you are looking at your profit and loss. You are looking at your income, whether you're going to generate any or whether you've generated a loss, right? So that's where we're going to go from there. So gross receipts, pretty much money coming in, right? So money that you earn for your services and just the revenue that's coming in from what you do. And so your business expenses are the money that's going out, right? So what are you selling? What are you spending your money on? And the government makes something very simple. It's when you have an expense, it must be ordinary and necessary, right? That's a big deal, right? Because you can't just expense anything because a lot of people think they can. And things that you expense are, let's say you're a lawyer and you gotta pay for internet and you gotta pay for paper and you gotta pay for pens and you gotta pay for stuff like that. Now, when you have computers and stuff that's a depreciable asset, that's a little bit different, and so that goes under capital expenses, right? And you definitely exclude personal expenses and anything that is part of cost of goods sold. Why do we exclude cost of goods sold? It's really simple, right? Because the way the government does their income, their tax return, which you can see here, is that in their tax return for example, it's an 1120S, they take out the cost of goods sold. So when you're inside of here, your actual total income, this is from the IRS 1120S, is going to be after you take your gross receipts. So let's say you spend 100K and then you have 50K cost of goods sold. So you have 50,000 of total income, and then you start subtracting your expenses, right? Your ordinary necessary expenses are subtracted here. And so once you go from there, the government sort of gives you this outline of what is something that's allowable, what is not allowable, and things of that nature, right? So I see a lot of people commingling personal expenses, which is why when I created SyncBucks, it was really important for me to be able to filter out things like, for example, let's say you did everything in Starbucks, right? So you like all your personal expenses are at Starbucks, and so now you got to turn all these in. These are not expenses because it was just you going to Starbucks. So then we just take them out, and then that way you're like, oh, this is not deductible, right? So it's not deductible. So you just take it out out of the logic that you're going to use to create your P&L, right? So now it's all like personal expenses. You can even add another subcategory to make it personal expenses, right? So the government's really clear, what's personal and what's business. So this kind of stuff just really helps you out. Very fundamental, right? And so what is a profit and loss? It's so easy, right? In its general sense, sure. If you're making like millions of dollars and it's like this like really sophisticated system, like I said, you need something way more advanced. You need like a full-time, maybe a staff accountant, right? But for something that's like, mom and pop shop, you're making $800K a year at your burger shop, seems like a lot of money. It's about $80,000, $70,000 a month, but you're only walking away with $90K, right? So if you're in this field, you kind of see the struggle that people do when they have their small businesses. It's not like all nice. So even though the revenues or the gross receipts seem high, the income is quite low at times, the margin. And so profit and loss, showing the money coming in that you earn and the expenses that you spend in order to earn that income, right? And so the government says gross receipts, income coming in, expenses, money going out that's ordinary necessary, right? And so go back to what I said, nowhere in here does it say that you require QuickBooks or anything like that, right? It's very simple, it's very basic, right? Because at the end of the day, what's going to end up happening is that you're going to be on your profit and loss here, and then you're going to give it to your tax preparer, and then your tax preparer is going to put it on a form that looks like this, right? So when I created SyncBooks, I made it simple so everything just instantly starts to flow into a tax return, getting you ready for your tax return, right? So I keep it very simple. So this is an accounting system that works.